Okay, so in this video today, we're going to be looking here at chapter 4. And in chapter 4, we are looking at merchandising operations. So whenever we're looking at merchandising operations, we're going to move a little bit out of what we've been doing in the first 3 chapters and start applying some of these ideas to another area, right? So here in this first question, and hopefully at this point you've already watched the lecture video on chapter 4. So now that you're working through the homework, this first question really just goes through a lot of the terminology in this chapter. It's not the most exciting question in the world, that is to be fair, but it is quite important that you understand these terms because we'll be using them very, very frequently throughout this chapter. So the very first thing that we're going to be looking at here is a formula. It's not quite as clear as we would normally write a formula, but the key here is that we are calculating gross profit. When we calculate gross profit, of course, we do that by taking our net sales simply minus cost of goods sold. So you should have seen cost of goods sold defined in the lecture video. It is an account we have not seen up until this point in the semester, though, so we'll talk about it a little bit more here in just a second. So cost of goods sold is going to become a very important account from this point forward, really. So do get used to it. A couple of key things you're going to want to remember for sure, right, is cost of goods sold. That account, of course, is going on the income statement. And you'll notice that whenever we actually prepare our income statement in this chapter, this is kind of the format for that very top section, right? So the very top section of our income statement from now on, all right, we're kind of moving away from this just very general idea of revenues minus expenses equals net income. And in this chapter, we actually get a more formally defined income statement. And this right here, net sales minus cost of goods sold being gross profit, will be at the very top of our income statement from this point forward. So very good. So I'm going to go ahead and clear all of that off, and that takes care of our first item. So that, of course, is the formula for gross profit. So the next piece here, this tells us this is a current asset that includes the cost to buy goods and make them ready for sale. This is very strictly just what we define as inventory. So this includes a very important item that people often forget, is that it's not just the cost to buy the goods that we're concerned about here, but it's also that cost necessary to make them ready for sale. So if you got something that you bought, but it's not quite ready to be sold yet, and it requires some additional labor, some additional parts applied to that, whatever it is, maybe it requires some shipping costs, whatever it is that makes this available and ready to be sold, that will be part of our inventory cost. It's a very important idea in this chapter, so it's very important that you understand that it's not just the actual cost, it's also there's additional items that make this ready for sale. Next, we see here the purchaser's description of a cash discount received from a supplier. This is pretty much exactly what it sounds like. This is just the idea of a purchase discount. So of course you see that here. Merchandisers, this is going to be any business that buys and sells merchandise, right? And that's how they actually do their business primarily. This is, for example, Walmart, Kroger, anything like that, right? We're buying and selling merchandise. Then our next two pieces, these next two kind of go hand in hand. So it works out really nicely that those are together, because a periodic inventory system and a perpetual inventory system only differ in when we actually make the entries for stuff occurring related to inventory. So with a periodic inventory system, you'll notice this occurs only at the end of the period. That is the key, right? We see the word period here. This is periodic, right? That is not a mistake. That's not a coincidence, right? That is intentional, indicating to us that we will only update inventory for purchases, notice, and sales. So not just one or the other, right? But we indicate purchases and sales at the end of the period. Purchases and sales at the end of the period. A perpetual inventory system, on the other hand, though, updates our inventory records for each purchase and, once again, those sales on the day that the transaction occurs, right? So as this is actually happening, it's perpetual, it's consistent, right? So this is happening over and over and over. Now, the next thing that we see here, number 7, the expense of purchasing and preparing the merchandise to be sold during a period. This is exactly what cost of goods sold is defined to be. All right, so this is the cost of the thing that we've sold. So it's named pretty aptly, so we do like that one. And then, of course, This is kind of the opposite of what we saw earlier with the purchase discount is the sales discount. And this is the seller's description of a cash discount granted in return for early payment. And this will be a very important idea in this chapter as we'll get into a lot of terms of sales and other things like that as we move through this chapter. So that wraps up number 1. So with that, we'll go ahead and move into number 2. So here with number 2, this is where we start getting into those terms that I was talking about with those sales discounts. So in this case, we are computing the amount paid, assuming all these invoices are paid within the discount period. Now, truthfully, this works the same way if I'm the buyer or the seller as far as this computation right here, right? If I'm the buyer, then I will pay this amount. If I'm the seller, I will receive this amount, right? But that's kind of the idea that we have. So in this case, what we're told is that we have this gross purchase of $5,400 and my terms are 210 and 60. So if you watched the lecture video already, then you should be hopefully familiar with what those terms tell me. But the way this works is the first term here, that 2, this indicates the percentage that I will actually save if I pay within the 10-day period. So this is my time period that the discount is actually available, right? So this is what we call the discount period. I'm just going to call it the time period because I'm having to write with a mouse, which is kind of difficult, and time is easier to write than discount. So this is the time period that discount is actually available. And then we see the N 60. Right, so if we choose not to pay within the 10-day period, the net amount, right, that remaining balance, which would then be the full amount, is due in 60 days. So this is when payment is actually required. So payment is required at this point in time. Up until then, I can pay if I want, but I must pay by day 60. So this brings about a really important item whenever we talk about managing cash flow for your company. Truthfully, there are only 2 days that you should even consider paying this, right? There's only 2 points in time where it would even make sense to maybe pay, right? And this would be day 10 or day 60, right? If I'm going to pay early, then I shouldn't pay any earlier than I have to pay to get the discount. In this case, that is day 10. But if I'm not going to pay early, if I don't pay by day 10, then there's absolutely no reason for me to rush and pay this on day 14 or on day 38 or on day 54, right? In this case, there's no reason for me to even consider paying if I don't pay in that first 10 days until day 60, because the longer I have my own cash, the better off I am. Right? There's no incentive for me to pay on day 18, for example. So if I miss day 10, right, maybe the bill got caught up under some clutter, maybe it got misorganized or put in the wrong file, but I don't find it until after day 10, don't rush to pay it. Set a reminder, set an alarm, right? Set a calendar alert, whatever you want to do, and pay that thing on day 60. Keep your cash as long as possible. At the same time, if I want to take the discount, don't pay on day 1. Don't pay on day 4, day 7, day 9. Pay on day 10. Because once again, the longer you can keep your cash, the better off you are, right? What if you had some unexpected expense pop up and you've already rushed to pay this bill ahead of time, and now you're not able to actually pay it, right? Now you're not able to cover that expense because you already put in this money on something that didn't have to even be paid for quite a while. Now, there is a formula, if you want to actually look that up, you are welcome to, that will tell you the actual cost of missing out on these discounts, and it's quite high, right? Assuming a continual contractual item, right? So say we're offered these terms continuously throughout the year, well, then missing this, right? Missing this discount turns out to be incredibly expensive, right? Even though it only looks like it's 2%, the annual rate on that is somewhere between, let's say, 25 and 40%. I can't remember the exact number off the top of my head, but we could certainly calculate that out if you're interested. So what you'll actually find is that in practice, if you are offered these terms, you take them, right? If that means you have to go to the bank and take out a short-term loan to take advantage of these terms, it is almost always better to do that than to miss out on these terms, right? Because it's very unlikely that the loan you're getting from the bank is carrying an interest rate of 20, 30, 40, 50%, which can be the annual effect depending on how these terms are set up if you start missing them. So if you're offered them, you take them in practice. If you are not offered these terms, then you just pay whenever the bill is due. And what that also means then from structuring your own business is that if you are considering ways to generate cash, this is a terrible way to do it, right? It ends up costing you a tremendous amount of money to offer these types of early payment discounts. But if we are the buyer, you absolutely want to figure out a way, if at all possible, to take advantage of these discounts. And you can see then that the way this worked was to get this actual $52.92. What we did was we took $5,400, which was the amount of the actual bill, times 1 minus the amount of the discount. And in this case, that discount was 2%. And when you do that, that will give you the $52.92. So this is the actual amount for the check that you should be writing, notice, on day 10, right? There's no incentive, once again, to pay on day 6, to pay on day 8. So write that check for that amount, but do it only on day 10. Okay. Now, for letter B, we come in and we look. On letter B, we've got the same type situation, but we have a slightly different notation. You'll notice here, this notation is EOM, right? That just means end of month, right? So we'll pay this at the end of the month, is when the bill is actually due. And if I want the discount, I have to pay within 15 days. Of course, in this case, that would be a 1% discount. So the standard way to read that term then is we get a 1% discount if we pay within 15 days. Otherwise, the bill is due at the end of the month. So assuming, notice, that this is paid within the discount period on each of these, then this calculation is simply 20,600 times 1 minus 0.01. And when you do that, that will give you the 20,394 that we see right here. So this is the way that we're going to work through each one of these. And it's very important, especially as you're first seeing this for the first time, that you walk through exactly what that notation is telling you, because we'll be seeing this notation not just in this chapter, but for the entire rest of the semester. It keeps popping up. So it's a notation you certainly want to get very familiar with here in this chapter. Okay, so I'm not going to go through C and D because they are identical to how we did A and B, but just continue working through those, and then you'll be finished with number 2. Now, number 3. Here we're going to start looking at some journal entries. So they tell us here, prepare the journal entries to record each of the following transactions. And notice what they tell me, something very important here. So I'm going to switch over to my highlighter real quick, is that this company uses a perpetual inventory system, and notice the gross method. Both of those are incredibly, incredibly important items that we have just been told. The perpetual piece tells me that anytime there is a change in inventory, a journal entry happens on that day. The gross piece is not quite as important in this class because we typically only cover the gross method in Accounting 2301 or in this first accounting course on financial. But as you move on in accounting, you will also run into what is called the net method, right? So if we were covering both, this would be a very important piece of information indicating exactly how we're going to handle any discounts that pop up. But in this case, we're only using the gross method, so don't pay too much attention to that, but it is certainly worth noting that as you continue to move up in accounting, that piece of information will become incredibly, incredibly important. So on April the 1st, we see that we sold merchandise for $7,200 with credit terms in 30. Notice, right, no discount here. So the credit terms are that this is just due in 30 days. Dated April the 1st, cost of the merchandise was $43.20. So once again, if you've watched the lecture video, what you should have found was that anytime I have a sale of inventory, right, so anytime I've got a sale of inventory, that will require me to make 2 journal entries. Always. You must have 2 journal entries, at least in this class. Could you combine the 2? Sure. Right? If you want to do what's called a compound entry in practice, that's perfectly fine. In here, in the way that the homework and the test will ask the question, you will be required to do 2 separate journal entries. So basically, this breaks out into 2 different ways to do this, right? Or the 2 different things that we need. The first, just going by with the order that they've done this, is to record the sale. Right? Go ahead, record the sale. This means essentially figure out the entry regarding revenue. The second entry is dealing with cost of goods sold. In other words, this is the expense. right? This is the entry dealing with that expense. So what we see then, and truthfully, if I'm preparing these, I like to flip these two, right? Where I do the cost first and then I do the revenue second, because I believe it's very rare someone is going to forget to record revenue. I think you're more likely to get caught up doing something and forget the expense, right? But the way the homework typically asks for it is in this order: sales first, then the cost. So that's what we'll do here. So the way this works is we need to parse the information very carefully, right? We sold this for $7,200, indicating that is the amount that this was actually sold for, or what we call the sales price. So this is my sales price. Then we see the cost of the merchandise is $43.20. This is my cost of goods sold. So if I actually asked you, and it doesn't in this case, but if I asked you to give me the gross profit, well, you would say, well, that's easy. Gross profit is net sales minus cost of goods sold. So I can actually compute gross profit on an individual sale, in this case, 7,200 minus 4,320. And when you do that, right, so you take your 7,200 minus your 4,320, you should come out to a gross profit here of 2,880. And then I could even go further and say, well, what is your gross profit percentage? Well, if I do that, that is simply gross profit, 2,880, divided by the sales price of 7,200. So if you do that, what you would find is that this actually comes out to 40%. Now, this stuff right here, right, question did not ask for, but it's good to be able to do that and to recognize the application in different instances, in different settings, right? So while that was not required for this problem, certainly something we will be seeing pop up not only in this chapter, but in future chapters as well. So whenever we deal with this sale, we also need to be careful in recognizing that we sold this, notice, with credit terms. Or I could have said we sold merchandise for 7,200, comma, in 30, right? If I say that, even if I don't say with credit terms, this is the notation for credit terms. So you should be able to pick up and go, okay, we did not receive cash, which is why the debit here is to accounts receivable, right? This was sold on account. So we have an entry, and we have an entry debiting accounts receivable, increasing that account, and notice a credit to sales. I don't like that they just call this sales. Personally, I call this always sales revenue. That way I remember, right, at least for myself, that this is a revenue account, and revenue accounts go on the income statement. It just keeps me that much more clear on exactly what is happening. If you want to use just the sales notation like the homework does and the test does, that's fine, right? And then in this case, in this class, that will be how you earn the points. But don't ever forget, right? This is really sales revenue, not sales, but really sales revenue. And that makes it a little bit more clear whenever we're looking down through a chart of accounts or we're looking through a lot of transactions, that this one goes to the income statement. And we see that very, very clearly there. So that is my first entry. My second entry deals with the fact that I've sold this. So I've already booked the revenue, but I can't sell that item again. So now what we're going to see is that a debit to cost of goods sold, because cost of goods sold is an expense, is increasing that balance, and a credit to inventory, because inventory is an asset, is decreasing that balance, which also leads us to a very important picture that we saw in the lecture. If you've managed to watch that already, or if you've been to class, there's a very good chance that I actually drew this on the board, and in truth, it looked much nicer in the PowerPoint lecture and in class, I'm sure, than it does here. But the way this works is at all points in time, my beginning inventory plus my purchases, this is the P, plus my purchases, gives me an important subtotal that I'm going to abbreviate COGAFS. So COGAFS, cost of goods available for sale, right? And that's what it is. And this splits, right? You'll notice this total, whatever it is, splits in one of two ways. So at the end of the period, one of two things has happened with inventory. I've either sold that inventory, so I have cost of goods sold for that piece, which of course is found on the income statement, or, right? The alternative is or, right? If I haven't sold it, I still have it. So if I still have the inventory, then that will be found in ending inventory, which is of course an asset, which means that this will be found on the balance sheet. So this table right here, right, will be used a tremendous amount here in chapter 4, but we'll also see it used a ton in chapter 5 when we're actually dealing with inventory. But in truth, you can do this with almost anything, right? Let's start back in the corner, right? Maybe this was supplies. Plus the amount of supplies I purchased gives me the cost of supplies available for use. Then I've either used them, which gives me supplies expense on the income statement, or I still have supplies on the balance sheet. Right, so if you don't like T accounts, maybe you like this picture better. You can modify this picture to work for almost any situation I give you where you're adding and subtracting things and you need to know, well, how much did I have available at some point? And then you can tell the split exactly how much was left. So that's the way this works. Now, we'll start to go through these entries a little bit more quickly as we start to hit some repeats here in a little while. But for the number 3, we'll go about this pace pretty slowly all the way down. So on April the 4th, we see the customer in the April the 1st sale returned $800 of merchandise. Notice for full credit. Merchandise had a cost of $480, and that is returned to inventory. Now, this is a very important thing because this is what is called a sales return. So notice in the reading of this question, right, and I'll switch this over to yellow to make it a little bit more clear, this was returned, right? It was actually returned, which means we received it back. So what I'm going to do now, I'm going to just clear everything off just to give us some more space. But what I need to recognize is that just like when I have a sale, oops, let's get us back to the blue. It's a little bit easier to see. Just like when I have a sale, that requires two journal entries. Returns also require 2 journal entries. And it does the reverse of what the sale did. So the first journal entry that they do here is to actually reverse the revenue. All right, so reverse the revenue. All right, so get rid of it. And the second thing is we return to inventory. Return to inventory whenever I have this happen. Right? Whenever I have an actual return, right, that means they gave it back to me. And when they give this inventory back to me, that means that I actually received it again. So now I can sell that. So maybe they bought too much. Maybe they bought the wrong size. Maybe they bought the wrong color, right? Whatever it is, this is inventory that is perfectly fine. They just don't need it, right? So for some reason, not that the inventory is broken, right, or damaged, right? We'll deal with that in just a second. But we actually have good merchandise coming back in the door. This is what's going to happen. Now you'll notice I told you this is essentially a reversal of the first entry. And you can see that happening here with the credit to accounts receivable, pulling accounts receivable down. But you say then, if this is a true reversal of number 1, then why is the debit not to sales, right? That would be a true reversal. Well, the idea here is if I'm running my company, is there a difference in me never making the sale and the sale not staying sold? Well, sure, right? It's kind of like whenever we talked about depreciation back in chapter 3, right? Initially, we said, well, there might be a difference in me crediting the actual asset for depreciation and me crediting that contra account. By crediting that contra account, I can still tell that I have the asset, its value is just coming down. We're trying to accomplish a very similar task here in chapter 4 by use of this contra revenue account, sales returns and allowances. And because this is a contra revenue account, and we know that revenues increase with a credit, I know that sales returns and allowances, that contra revenue, must increase with a debit. So here, that account balance is actually increasing. And you'll notice that this is for the amount that they told us that we sold this for, right? So they returned $800 worth of merchandise, indicating this was related to that $7,200. But then they tell us had a cost of $480. Well, that is related to the $4,320. So this piece is coming back in reducing my revenue by that amount, by the 800, and is reducing my asset by that amount. The next entry, right, the second entry on April the 4th, this is dealing with the cost. This is, in fact, a complete flip of the previous entry, right? On the second entry here on April the 1st, cost of goods sold went up, inventory went down. But here, inventory, of course, being an asset, is increasing, and cost of goods sold is coming down with a credit because it is an expense. Now, the very important piece that you need to understand with the title for this account, cost of goods sold, is that very last word, right? Pay very close attention to it. What is it? It is cost of goods sold, right? Sold, meaning it must stay sold. The reason this had to come back is because this does not stay sold anymore, right? This has not stayed sold. It actually came back in because it got returned. So then the cost of goods sold must go down, reducing that expense on the income statement, and consequently actually increasing my income in this part, where here we're decreasing my income because that will reduce my net sales at the top of my income statement, resulting in essentially that canceling each other out and bringing us back to essentially a situation where we only made a sale of 7,200 minus 800 in the beginning, with a cost of 4,320 minus 480 in the beginning, which is essentially what has happened at this point now that we have moved through all of this. So on the 8th, we see here we sold merchandise 3,100, credit terms this. Once again, we know this is a sale, so it's exactly like what we did in 1 and 2. Debit to accounts receivable for the amount of the sale, credit to sales. Once again, remembering this is truly sales revenue. Then we debit cost of goods sold, credit merchandise inventory. I will tell you, much like I told you in chapter 3, this format for this entry, right, is something you want to commit to memory. Anytime you ever have a sale, this is what it will look like, right? A debit to accounts receivable or possibly cash, a credit to sales, a debit to cost of goods sold, a credit to inventory. If you remember this, it will make your life much easier. If you do not remember this, you will struggle in this chapter and going forward. This, much like that depreciation entry, is one you absolutely need to know forward and backward, right? Very good. Now, on April the 11th, we received payment for the amount due from April 1st sale. Let's notice the return on April the 4th. I will tell you, I may not always point out that it's less the amount that was returned on April the 4th, but of course you should be able to tell that, right? This is related to that April the 1st sale, and they told us they sent some stuff back. So how much cash should we get? Well, we came in the initial situation, we set up accounts receivable for 7,200. When they returned some stuff, right, we credited accounts receivable for 800, bringing that down. So the amount that they actually owed me at this point in time was $6,400. And now the only thing I've got left to consider is, well, was there a discount offered? And we look back at the terms in 30, there was no discount. So this is the actual amount that they'll be paying. That's where this 6,400 comes from. And now it's just like any other account that's been paid off that we've seen all semester. A debit to cash, indicating the cash coming in, boosting cash, a credit to accounts receivable, indicating they no longer owe us. So that account, of course, is going down. Remember, when we see the receivable here, that tells me I'm dealing with an asset. Assets have that normal balance of a debit. So by crediting that account, that balance is decreasing. Okay. Now, for this next problem, right, it's another pretty definitional question, just about the differences between what's called the single and the multi-step income statements. So in the first few chapters, we did a single step income statement, basically just revenues minus expenses, and that gave us net income. What we'll see in this chapter is a bit more expanded version of the income statement. I'm not going to try to write it over here because it's very difficult for me to write with this, and it's quite a bit of writing. So we'll just talk about this, and then we actually have a problem in a minute that walks us through the actual preparation of the multi-step income statement. So in this case, we say the statement is limited to 2 categories, revenues and expenses. That is, of course, the single step income statement, right? And the problem with this, right, is that it indicates that all revenues are equal and all expenses are equal, and that's not really true, right? if I generated a revenue from actually selling my product or my service, that is a superior revenue to maybe me just getting some interest revenue, right? Maybe my company invested in a bond and we collected some interest, right? Well, that's not related to my primary business operations. So maybe we should treat that just a little bit differently, right? Maybe we should try to break this out for my shareholders, for my investors, for the public, for the regulators, in a way that they can tell, okay, here's the stuff that really matters to the core of the business, and here's just some other stuff that we do on the side, right? The single step income statement does not do that. The single step income statement throws all of your revenues in one bucket, throws all of your expenses in one bucket, and then takes the difference and calls it net income, right? And that was okay for the first exam, but now we've graduated up a step and we're going to see how this actually should be done. So these next three items are all descriptions that pertain to the multi-step income statement. So this reports gross profit on a separate line. So this is where we saw earlier that net sales minus cost of goods sold, giving us gross profit. And we said that would be very important, and it is, right? And that's actually a computation that we'll be seeing on our income statement in just a minute. We will then see that we have income from operations, right? The thing that we primarily do will be separate from revenues, from other revenues, right? Things like interest and then gains. So for example, if I'm McDonald's, right, I make my majority of my profit, hopefully, by selling food to my customers, right? That revenue is different than the gain that would be recognized if I sold all of my property at a massive gain. Let's say, for example, McDonald's sells all of their property and books in this year a $10 billion gain, right? This absolutely massive gain. I have no idea if they could do that or not, but let's say that happens. Well, what we find in this chapter is that gains go to the income statement, which means that gains influence net income. So if I was looking at a single step income statement, I would see this massive gain coming in, boosting net income. And I would be tempted to go, wow, McDonald's generated a tremendous net income this year. Everybody, let's go invest in McDonald's. But if we don't look a little bit more carefully at where that net income was coming from, then we just invested in a company that has no property, right? No buildings, no equipment, no land. All of it's gone. Well, can they do business next year? No. Can they sell their property and their items again next year? No. So this gain cannot be repeated, right? That is the problem with gains, and that is why we treat them a little bit differently on the income statement, as we'll see in just a minute. Our income from operations, that's the bread and butter of the company. That's the stuff we do every day. That's the stuff that can be repeated. These other revenues, these gains, these losses, all that kind of stuff, that may or may not pop up again, right? So we shouldn't be counting on that. So we should be breaking our information apart in a way that makes it very clear to the reader what is happening in this actual company. So very good. Now, number 4, report subtotals for various classes of items. Of course, there's not a subtotal for here other than just total revenues and total expenses. So there's really nothing happening with the single step income statement. The multi-step income statement we will see in just a minute has quite a few subtotals with it. So that brings us to the end of question 4. So we'll now be moving into question 5. Now, here in question 5, we're going to look at a ratio. It's very closely related to a ratio that we saw earlier in the course. Of course, the parallel ratio, or the very similar ratio, is what we call the current ratio. Let me fix that and make that an R. So we have our current ratio. And we said current ratio was current assets over current liabilities. And we liked it because it was a nice, easy formula, right? If it was a current asset, it went in the numerator. If it was a current liability, it went in the denominator. And whatever that was, right, that was some number. And that told me what percentage of my liabilities that are due within 1 year that I have assets to cover, right? So hopefully we were getting something at 100% or higher, right? If I got, say, 65%, that would tell me for every dollar in current liabilities, I've only got 65 cents in assets to pay for them, right? That might be kind of a problem, right? That means for the stuff that's due within a year, I'm only currently having 65 cents to pay for that stuff, right? Now, there are workarounds. Certain industries just have very low current ratios, and that's fine. But it is certainly something worth looking at, worth being a little bit concerned about. In this chapter, the focus is not on the current ratio anymore. It is on the more conservative ratio, which is the quick ratio or the acid test ratio. I'm just going to call this QR for quick ratio because that is another very common name for this ratio. And it's much easier for me to write. So we have the quick ratio here, which I think is a little bit cleaner too, because it is quick assets divided by current liabilities. Now, let's see, right? Current ratio, we said current assets over current liabilities. So we notice then that this current liability piece, that has not changed. That is the same in both of these. But what we find is that this current asset number always, right, always will be, so I'm going to write an equality here, current assets, CA, will always be greater than or equal to quick assets. Has to be. Absolutely has to be. Because there are assets included in current that are not included in quick. So what that tells me then is that if the denominator has not changed, and at the very most, quick assets are equal to current assets, then what I can say is that the current ratio will always be greater than or equal to the quick ratio. Has to be, right? Because this right here, my quick assets are smaller than my current assets, most likely, right? There are instances where they could be the same, which is this equal here, but in the vast majority of cases, my quick assets will be less than my current assets, which gives me a more conservative ratio, which tells me, right, this one typically is a little bit smaller, maybe a lot smaller, because it doesn't include things like inventory. It doesn't include things like prepaid expenses. All of that type of stuff is not included. Those are not quick enough, right? They're not very easily able to be turned into cash. And if we actually look back at our acronym for our current assets, we'll find those items are a little bit lower down. And what we also find is that it's very common for companies to overbuy inventory. And we'll get into why that may happen, or to overproduce inventory, a little bit more in the second accounting class, and see that we can actually manipulate income sometimes by just adjusting my inventory levels. It can be very problematic. It's also a reason why it's very difficult to evaluate management if you don't understand how cost accounting really works, which is why so many of you will be taking the second accounting course. But here in the first accounting course, this is pretty much what I'm worried about, at least in this problem, is my cash and my accounts receivable. So those will be quick assets. And of course, this is more specifically defined in the lecture video as well as in the reading, and we'll go through it a little bit more detail in class, of course. But this is what we're calling my quick assets for this problem with the information we've been given. So this 4636 is my 1300 plus my 3336, and that equals that right there. So that is this numerator piece. And then my current liabilities, of course, current liabilities being anything that are due within 1 year. And they tell me I've got accounts payable of 5,500 and other current liabilities of 600. Adding those two together gives me the 6,100. So this is the 5,500 and the 600 coming down to give me that total right there. Now, what this tells me is that for every dollar in current liabilities, I have 76 cents to pay for them. Maybe not the greatest ratio ever, right? I would really like to see this at least at a 1, right? 1 or greater, right? So something greater than or equal to 1 for my quick ratio tends to be thought of as good. A quick ratio less than 1 tends to be thought of as not very good, right? Because it indicates that unless I'm able to sell some of these non-liquid assets, I'm not going to be able to pay my bills, right? Now, if my company primarily does sell a lot of inventory, maybe that's not something I'm that worried about, right? But it is worth monitoring. It is worth monitoring, okay? And this also is very good because it punishes companies who try to build up their inventory to some massive level, right? To keep that cost from hitting on the income statement. But it does start to come through here. So we say in the next class that there are some ways to manipulate income by boosting inventory, but then you're going to kill this ratio, right? So it is a way to kind of disincentivize that behavior, right? If we're making sure that our investors are looking at the full picture. So that wraps up at number 5. Now we're looking at number 6. Number 6 is going to be the same type of item all the way across here. So we'll just do maybe the first 2 companies, and then I'll leave the last 2 for you. But you should certainly be able to do those once we have completed the first 2. So in this case, we'll be looking at Carrier and Lennox. And they ask us to compute net sales, gross profit, and the gross margin ratio for each of the companies. So what we have to recognize is that up until this point, I've just said that like gross profit, that is equal to net sales minus cost of goods sold. But I haven't given you the formula for net sales in this video, right? If you watched the lecture, we covered it there. But in this video, we've not gone over net sales. So the way we'll do this is we'll take my gross sales, or what they're just calling sales in this question, but I'm just going to write out gross sales to indicate that it is a different number, minus 2 things. One of those things are my sales discounts. So that'll just be sales DIS, right, my sales discounts, and then minus my sales, I'm just going to put R and A, right, for returns and allowances. Now we saw the journal entry for a return earlier. We did not see the journal entry for an allowance. I believe we'll see it in just a little bit. But once I take my gross sales and subtract these 2 items, then I will come down and have net sales. So what you could do, I'm not going to, but what you could do if you wanted is where this says net sales, you could replace it with those 3 lines and put gross sales minus sales discounts, minus sales returns and allowances, minus cost of goods sold is gross profit. That would also be true because we just established that this right here is equal to net sales. Therefore, anywhere I see net sales, I could just plug in those 3 things. And so if you want to do that, just so you have it clearly in your notes, feel free to do so, but it is certainly not required. So with this established, it makes this question a little bit easier to see. So here we go. In this case, we'll start off with sales. Sales are 151,000, right? This is what I'm calling gross sales. So for Carrier Company, we'll take 151. Then we'll take minus, so 100, I'm just going to leave off the zeros, 151 minus 3, which is my sales discounts, minus 15, which is my sales returns and allowances. That will give me, right, 151 minus 18 is 133. So this right here is how they got the 133,000 for net sales. Now, gross profit. Well, for gross profit, what we have to do is we say, well, that's net sales. Well, we've got that number minus cost of goods sold. Well, turns out they gave me that number. So 133 minus 90,307. And I guess we'll keep up with the zeros for this one. That difference, let me do that real quick. So 133,000 plus a negative 9,307 is 42,693. I apologize for the phrasing there, plus a negative. I'm using a 10 key, and that's the syntax for it to work correctly. So this is really just minus the 90,307. So don't let that confuse you. But 133 minus the 90 is 42,693. And you'll see that is what they have right here. And then, of course, the gross margin ratio we covered very briefly earlier as gross profit divided by sales. So this right here is the gross profit divided by my sales. But notice this is divided by my net sales. This will be gross profit divided by net sales. So for Carrier then, this is 42,693 divided by my net sales here, which we established was 133. So when you do that, this will come out to 0.321, which of course, when you make that a percentage by multiplying by 100, will come out to 32.1%. And so that is my gross profit percentage for Carrier. And now we'll repeat this process for the next 3. Right, I won't write out how we do this for the second one. I'll just kind of talk through it and point. And it'll speed us up a little bit. Right? I don't want this video to get overly long, but here's how we do this one. For Linux, we'll take my sales, 570, minus 12,500 minus 6. That gives me 551,500. That's my net sales. We will then subtract 357,372. That will give me gross profit of 194,128. I will then take 194,128 divided by 551,500 for 35.2%. And we'll repeat that process, of course, for the last two companies. Now, for question number 7, all right? So for question number 7, we're going to look at what is called shrinkage for a perpetual inventory system. So what shrinkage is it recognizes that throughout the period, maybe some of my inventory got stolen, maybe some of it got broken, maybe some of it went bad, maybe I sell fruits and vegetables and some of it's expired, maybe I sell milk or some other perishable item, right? But throughout the period of time, something could have happened that means that my inventory isn't quite what it used to be. So let's see how this works. In this case, they tell us Nixit Company's ledger on July 31st, is fiscal year end, includes the following selected accounts. Notice they are nice here and they tell us these have normal balances. This won't normally be told to you. This just kind of assumed that you know that these accounts will have normal balances, but here they specifically point that out and they tell us Nixit uses perpetual inventory system. And they say here a physical count of their inventory as of July 31. Notice their year end. So not a 12/31, not a calendar year end, right? We haven't seen this too much at this point in the semester, but it is something we'll be seeing more and more as we move on through the course. And in the next course is varied year ends. So they tell us here physical count of its July 31 year end inventory discloses the cost of the merchandise inventory still available to be 42,500. So you say, well, okay, but when I look at the information I've been given, my inventory is already at 44.3, but we only have 42.5. Do you think that's a problem? I think it might be. So what we're going to have to do is go from what we have right now, 44,300, to what we know this to be, 42,500. And this comes down to a difference here of $1,800. So that tells me that there's $1,800 worth of inventory that I'm missing, right? I thought I should have had it. Turns out I don't. So this is where that chart that we drew earlier, right? Beginning inventory plus our purchases. I'm just going to put a P for purchases now because I've already written that once. This gave us cost of goods available for sale. We then said that split into two different parts. And we said this is cost of goods sold. And we called this ending inventory. Let's do EI. We said this is on the balance sheet. And this is on the income statement. So that's where we left it, right? This was the picture that we used to help us orient ourselves earlier. And it's one that we're going to use again, right? Because what this tells me is that at any point in time, right? Not sometimes, not occasionally, not when we feel like it, but at any point in time, my cost of goods available for sale will be ending up split between these two categories, right? It either got sold or it's an inventory, which means when I make the entry for this shrinkage, these are the only two accounts that can be used. And it makes sense, right? Because I thought I had this. Turns out I don't. So the adjustment has to involve those two accounts. Very good. So as we come down, we'll actually see what this entry looks like. And we noticed that we had $1,800 less than we expected, which means inventory has to go down and cost of goods sold has to go up. Because as we said, we either have it, indicating it hasn't been sold, or we don't have it, meaning it has been sold. Now, we recognize this is not perfect, right? It may not have actually been sold, could have been stolen or broken or spoiled or something else. But the fact is, we don't know exactly what happened to it, but we do have this account called cost of goods sold. And so to keep our records nice and clean, we're going to put all of that unknown stuff that might have happened into something that we can easily define. So we call this cost of goods sold for 1,800, reflecting the fact that this inventory has left, meaning that this will go to the income statement as an expense, of course, and this will be reducing my assets on the balance sheet. So all of that is holding out pretty well for us. So with that, we have finished that question. We are now on to number 8. Here in number 8, they tell us to close the balances in temporary revenue and expense accounts. Remember to consider the entry for shrinkage from 4-9. So what we find then, and let's see if we can get this to pop up nicely for us. No, we cannot. Okay, so what I'm going to do is I'm going to just leave this here for you for just a second. And you may want to take a picture or something of this just so you can see it as I talk about what is happening in these entries, because I'm going to be going off of what we see here, right? So I'll probably be kind of sketching it down on the side, but you may want to be able to see that, right? So if you want to see that, then make sure that you took a picture just a second ago. If you need to rewind it, feel free to do that. But basically what we're doing here is we're closing our revenue and expense accounts. So we look through all of this. I say, okay, how many revenue accounts do I have? I think I only see one. It's called sales. It's right there, right? Notice it's not called sales revenue in this listing. So you may skim past it, right? That's why I like to call that sales revenue. It catches my eye a little bit better, right? Just now when I looked at this, I thought, well, where's the revenue account? I don't see it. And the reason I didn't see it right away is because they did not indicate the revenue piece. All right, so I'm going to go ahead and write that in. But as we remember from chapter 3, when I close a revenue, because a revenue has a credit normal balance, I will be crediting income summary, which means that I will end up debiting sales revenue to bring that account down to 0, right? So this is actually going down all the way to 0 for a debit here of 161,100. And then of course we will be crediting that income summary account. Here, right, normally IS means income statement. I'm abbreviating this right here to be income summary. All right, so please don't let that confuse you. This is income summary, and that is for 161,100. I do strongly suggest you write that out. All right, absolutely, I would not use this abbreviation because later you'll look back and go, why are we crediting the income statement? We can't credit a financial statement directly. That doesn't make sense. All right, this is income summary, so make sure you do write that. Now, the only other thing that we now need to deal with is the closing of our expense accounts. So we'll be looking at our expense accounts, and we see here we've got sales discounts, sales returns and allowances, cost of goods sold, depreciation expense, salaries expense, miscellaneous expense. All right, I'm not going to rewrite all of these. I'm going to tell you, though, we are closing all of these accounts. And so when I close an expense, right, they increase with a debit. So to close them will require a credit. So I will be crediting all of these accounts. If you want to go ahead and start out by just filling in these numbers, feel free to do that, right? That's a good way to start. Of course, it won't be quite right for all of it. We'll fix it in just a second, but that would get you a good start. And then of course, remember the debit will be to income summary. So we'll debit income summary for whatever the total is that we come out with in a second, and we will credit each of those expense and contra revenue accounts. So all of those items will be dealt with. So I'm going to close this and just pop back down and then clear off all the drawings so we can see exactly what's happening here. Notice sales discounts, that was the number that was given to us. Notice the 5,200 was what was given to us. Notice this that was given to us, right? And I'm going to actually write that in a little bit different spot. I'm just going to write it out here to the side. The amount that was given was 108,900. That does not equal what they've recorded here, this 110,700. So we'll talk about why that is in just a second. But see if you can figure out why that might be before we talk about it. Depreciation expense of 11,600 is what was given. Salaries expense of 39 was given, and miscellaneous expense of 5,000 is what was given. So the only thing that really got changed here was cost of goods sold. And remember, this is because we made the entry for shrinkage after we had been given our balances, right? After we had been given our balances. So this 108,900 that was given right here did not include that $1,800 adjustment. So now whenever I come down and make this $1,800 adjustment to cost of goods sold, my true amount in cost of goods sold is the 108,900 plus 1,800, 110,700. And that is the amount that you see then recorded down below. So that is what is happening here, right? That is where this number actually comes from, right? That is where this 110,700 comes from, is from the fact that we start with what we were given and then add in the adjustment for shrinkage. Okay, so that handles question 8. And with that, we are ready to move on to question 9. Now, here in question 9, we'll be looking at some more journal entries. Some of these are a little bit repetitive from what we've seen earlier, so I may skim through those a little bit quickly. This video is starting to get fairly long, but I will point out anything that's different, anything that we haven't talked about before. So in this case, on April the 2nd, we purchased, right? So in this case, we are purchasing, we're not selling, $6,600 of merchandise from Lion Company, credit terms 215 net 60, invoice dated April the 2nd, FOB shipping point. So first thing that you should do, first thing, right? Nothing else matters until you understand what these terms mean. Nothing else in this question can be done until you understand what these terms mean, really. So what does this tell me? 2% discount if I pay within 15 days. If not, right, the net amount, the balance is due in 60 days. Write that down if you need to. Say that out loud to yourself as you're doing the homework, but make sure you understand what that phrase is telling you. Now, notice this is dated April the 2nd, and then we get this idea FOB shipping point. So FOB shipping point. I think you mentioned that in the lecture, but gosh, you know, we've talked about a lot of stuff. I'm really not sure what that means. So I'm going to try my best to draw a picture here. It's not going to be very good. I'll just be honest, right? But this is going to be a truck, right? Or some type of car, right? That's how we are imagining this. It's a very nicely drawn car, and it's getting on the road to go to a nicely drawn building, right? So here's our building. So this is like our store. There's the door. And basically, we've got some time period in this range, right? So this happens presumably on one day. This happens on some other day. We'll just call it a number, right? So some number of days later, we arrive, right? So that is the shipping process, right? We buy the thing, it gets put on a truck, and then eventually it gets shipped, and eventually it arrives. So what we're dealing with is there are two different types of FOB terms in this chapter. One is FOB shipping point, which is the one that we are concerned about in this case, FOB shipping point. And the other is FOB destination, FOB destination. So I'm just going to do DEST. Now, what you will notice between these two, all right, and I'm just going to draw a box around it, is that they both say FOB. Because they both say FOB, what I tend to do is I just don't care about the FOB. I just look at what comes after it, right? I find that most people who get confused in shipping terms, they let that FOB really mess them up. Well, FOB is the same in both, so it doesn't really matter. If you just want to know, right, FOB is free on board, but it doesn't affect the way that I work the problem. What affects the way I work the problem is what comes after, right? What comes after that point. And in this case, that's shipping point and destination. So what I see then is that the shipping point tells me when ownership changes hands. So who owns the thing at the beginning of this process? Well, initially, the seller owns the thing. And then at the end, the buyer owns the thing. So this is what is happening. When is ownership changing hands? That is what these two terms tell me. So at the shipping point, when ownership changes hands at the shipping point, the seller no longer owns this thing once it has shipped. It is now the property of the buyer, right? The buyer owns it. Because the buyer owns this, the buyer pays shipping under FOB shipping point, right? The seller will not pay for shipping something that is not theirs. So FOB shipping point, the buyer pays. FOB destination, right? This remains the property of the seller until it arrives, which means the seller pays for the shipping. So let's imagine we've got our truck. It's coming down the road. It's moving, right? It accidentally veers off the road and goes and crashes, right? So we've got some big fire down here, right? Truck's on fire, driver dove out at the top of the cliff. They're safe, driver's fine, truck crashes, everything in the truck burns up. So under FOB shipping point, for this to be insured, who should have paid for the shipping insurance? Well, that's the buyer, right? It's the buyer's item. It's the buyer's inventory because they agreed to pay the shipping, right? Shipping point. Ownership changes hands right then when shipped. Now it is the property of the buyer. Doesn't matter that it hasn't arrived yet, right? This stuff could still be in Northwestern California and my company could be in Southeastern Florida. Doesn't matter that it's on the complete other side of the country. This is my inventory the moment it is shipped as the buyer because it was FOB shipping point. What that also means is that since this is the terms, the seller gets to recognize revenue the moment the items are shipped, right? Very important. So maybe I ship this out December 30th from Northwestern California and put it on a truck. Is this going to make it all the way across the country, however many thousands of miles that is, all the way down to the very southeastern tip of Florida by the end of the next day? Probably not. But because this was shipping point, I've done the thing, right? As the seller, the thing is done. I get to book revenue on the 30th. Had this been FOB destination, and that doesn't arrive until, let's say, January the 5th, down in southeastern Florida, then the seller does not have revenue until it arrives. At that point and only at that point do they then have revenue, right? So these terms are incredibly important. This is an area that as an auditor, we used to look at a ton, right? Because you have to, right? This is the idea of cutoff, right? When did this happen? What did the terms tell me, right? If this shipped and it was FOB shipping point on December 30th, then the seller has revenue on that day, the buyer has inventory on that day, right? But if it was FOB destination, the thing is not done until it arrives. So when it arrives, then the seller has revenue, then the buyer has inventory. But until that point, nothing's really happened. So what we find then is that whenever you go on Amazon, right, and they say, if you spend $50, we will give you free shipping, right? So this is what my wife tells me all the time is, well, I was going to spend, $25, but then I needed to spend $50 to get free shipping. So I spent $40 more, right? So now we have the $50 and now we get free shipping, right? It's kind of self-defeating, right? The shipping probably wasn't going to be $40, but now we're fine, right? This is what happens, but this is the idea, right? Free shipping is not really free, right? Someone is paying the bill. In this case, the company is paying the bill so that you don't. So it is free to the consumer, right? That's what we're seeing here. So when you see free shipping, what that really is FOB destination, right? But if Amazon said, we'll give you FOB destination instead of FOB shipping point, assuming you spend $50, people would go, what? I don't really get it. What does that mean, right? So they say, oh, it's free shipping, right? People understand free. So we go with that. But the actual terminology that we're using here, right, in this chapter, well, that's FOB destination, right? Amazon is saying they will foot the bill until this thing travels from the truck, wherever they shipped it, all the way to your house. Then once they deliver it on your porch and you sign for it or whatever, then they have revenue, but not until that point, right? That's all that is being said here on this entry on April the 2nd, right? That's the situation. And in this case, it's FOB shipping point, right? FOB shipping point. So now that we've covered that, we are ready to go ahead and move on. So the actual entry here, well, on this date, we had merchandise inventory. So that went up by 6,600 and we bought this on credit. And we know that because we have the terms indicating the cash was not paid right away. So inventory has gone up and accounts payable has gone up. So on April the 3rd, we paid $370 in cash for shipping charges. And this is a very important point, right? In this chapter, the way that we will handle shipping, right? Notice, I meant to point it out, we are using the perpetual inventory system and the gross method, right? So when we are in this situation and we are dealing with shipping terms, right, and we're actually paying shipping, we remember that merchandise inventory includes not just the cost of the item itself, the $6,600, but also any cost necessary to get it here in a condition ready to be sold or used. If it's an asset, right? If it's a piece of equipment, right? And I've got to ship it here, then I'll add that to the cost of the equipment. Same thing happens here. So my inventory now is not just worth 6,600, it's actually worth 6,970. That'll be very important in just a little bit, but that's what we see happening. So notice here the shipping though was paid for in cash. It's a small cash payment. So we go ahead, credit cash, bringing it down, debit merchandise inventory, increasing that amount. Now on the 4th, we returned to line unacceptable merchandise had an invoice price of 900. So you'll notice here, I told you earlier, a return triggers 2 entries, but on April the 4th, we've just got 1. A return will trigger 2 entries when you are the seller because you are receiving the inventory back and having to reverse the revenue. When you are the buyer, you're just sending it back. So the amount you owe, accounts payable, right, will be coming down. So that will be going down with a debit. And then we sent back the item. So my inventory is also going down. Why? I don't have it anymore. I sent it back, right? And in this case, they tell us this is unacceptable merchandise, right? That's not too important to me as the buyer, right? When I'm actually making the entry, I just care that I sent it back. If I was the seller, right, and that was unacceptable because it was damaged, that would be very important to me. That would be very important to me, right? And we will see that actually play out either in this video or in class. So in this case, that is the entry for the 4th. On the 17th, we sent a check to Lion for the April 2nd purchase. Notice net of the discount and the return merchandise. So you say net of the discount, how is it net of the discount? Well, the purchase occurred on the 2nd. We had 15 days to pay for the discount, and this is the 17th. 17 minus 2, that's 15. So we are paying on the 15th day. So that works. So we do get the discount. So the question is, well, how did they get this 5,700? Well, the 5,700, that is 6,600 less the $900 that we sent back. So that's 5,700. So that's where this number comes from. The next question is, well, where did cash come from? Where did cash come from? So cash, well, that's going to be the 5,700 that I owe times the amount of the discount subtracted from 1. So I'm just going to do this here as 98%. When I do 5,700 times 0.98, I will come out to 5,586. 5,586. And that is the number you see here. Now, the next number, the actual 114, there's 2 ways to get this. You could take the 5,700 times the actual amount of the discount, 0.02. And when you do that, that is 114. The other option, of course, is to just take the difference between 5,700 and 5,586, because I know that the amount that I owe is the 5,700 in total, but I'm actually only having to pay 5,586, which means the remaining piece of that must be going to that discount. So now we say, well, how does this actually work? And why is this going to inventory? All right, why don't I have, say, a discounts received account? Well, this is where we really have to understand some of the stuff we've talked about already in the semester, right? And this really goes back to chapter 1. All right, so if you want to make a note here, this is tying into chapter 1, where we saw this idea of the cost principle. I believe it was actually like formally defined as the historical cost principle, but I'll just refer to this as the cost principle. And the way this works is that assets are recorded at cost. So you say, well, what was the actual cost? Well, the actual cost in this case was the $5,700, right? 5,700, the 6,600 minus the 900. All right, and for now, right, I'm going to ignore this 370 because it's not relevant to this piece of the question. So I'm just going to ignore it. But what's happening here, because it's not related to the credit piece, right? If this was somehow tied into the shipping terms, then it would matter. But because this was dealt with separately, we can ignore this for now. So I'll take the 5,700. But I then say, well, how much did I pay for it? I only paid 5,586. So if I don't reduce my inventory, then on my balance sheet, I'm showing my inventory worth 5,700 when my cost principle says it should be recorded at 5,586. Because those two things are not the same, this would be a violation of the cost principle. To remedy this situation, the thing that I have to do is to bring this down to that 5,586. And how do I reduce inventory? I credit inventory. And how do I go from 5,700 to 5,586? With a credit for 114. So that is what is happening here, right? It's kind of bringing it full circle from chapter 1 all the way up to where we're at now in chapter 4, making sure that you understand that cost principle. If you understand the cost principle, this entry seems pretty logical. If you do not understand the cost principle, you will have a hard time memorizing that that credit is to merchandise inventory as you're trying to memorize hundreds of other journal entries, right? But if you understand the cost principle that says assets must be booked at cost, and the cost is what I paid, well, when I don't pay the full amount, I don't get to recognize the asset at the full amount either. All right, so now we'll have to deal with that. So that's what's happening there on the 17th. On the 18th, we purchased $12,500 of merchandise from Frist, terms 110 net 30. So we get a 1% discount if we pay within 10 days. If not, the balance is due in 30 days, dated April 18th, FOB destination. So the first one, I believe, was shipping point. This one's destination. So let's see how this works. Well, in this case, we are debiting our inventory, crediting accounts payable, right? That works just perfectly fine. I do want to make one quick note, though. You'll notice that the accounts payable in this case is different than the accounts payable here. And that's because we've got multiple companies in this question. So the book does like for you, and actually in practice, we would keep up with separate accounts for each company that we're dealing with. That way I can look very quickly and tell how much do I owe Lion Company, how much do I owe Frist Company, et cetera, right? But I didn't mention it earlier. I think I just said accounts payable, but you do want to get in the habit, even if there's only one company, it's not a bad habit as you're working your homework on paper maybe, and just making notes to go ahead and include the company name. But typically there's just one company we're dealing with in the question, or if it just says we bought something on account, then we'll just say accounts payable. But if they give us that company name, go ahead and include it, right? It doesn't hurt anything. Now, in this case, we got the inventory, so that is an asset that it will increase with a debit, and we got the liability coming in, so that liability will increase, of course, with a credit. So we do see that. Now on the 21st, they tell us after negotiations, we received a $600 allowance toward the $12,500. What this most likely means is we received some stuff. It wasn't exactly what we wanted, but it was close enough that I can make it work, right? So maybe I ordered something, right, of this size, and they sent me something that was a little bit bigger, but I can trim this down if I need to and kind of force it into that size that I needed. And so I say, well, all right, I can make it work, so I'll keep it, right? It's better than nothing, but it's not what I ordered. So we say, all right, that works. Or maybe like a couple of weeks ago, my wife ordered her a t-shirt and it had some design on it, whatever it was. And she got a t-shirt and it had a different design on it, right? She kept the shirt. She could have probably asked for some type of allowance or something. She didn't. But in that case, right, what would have likely happened is if she was okay with keeping the shirt, they probably would have said, okay, yeah, we realized we sent you the wrong thing, but if you're cool with keeping it, then we'll send you $5 back, right? So is it what I wanted? Is it what my wife wanted? No, it's not. But it's close enough to the thing that she wanted that she's not going to go through the trouble of having to ship it back and deal with trying to get a refund for the full amount and all this other stuff. Instead, maybe the company just says, all right, we'll give you $5 off next time you come in, or maybe we'll give you $5 back now. But this is the idea of an allowance, right? The company's recognizing they've made a mistake, but it's not such a bad mistake that you can't make it work. So you're going to accept the not correct item in place of the correct item because you can deal with it. Right? You can. Now, if it's the totally wrong thing, right? Like you order a t-shirt and they send you a golf club, right? Maybe not, right? Maybe those two things aren't interchangeable, right? Maybe this is worth more, so maybe you decide to keep it. Maybe it's not, right? But you should probably let them know, like, hey, something happened when you were picking this out of the warehouse and you sent me the totally wrong thing, right? So that's kind of the idea, right? That would likely result in a return, whereas the first one, that is an allowance type situation. Now, on the 6th entry that we have here on April the 21st, how are we dealing with this? Well, in this case, I simply owe you less money. So I debit the accounts payable, bring down that amount that I owe you, and I bring down the amount of the inventory that I have, reducing that, of course, with a credit. Now, in the last entry here, we sent a check to Frist paying for the April 18th purchase. You'll notice we go back to the terms. 110, well, 28 minus 18, that is 10. So we did pay on the 10th day. We are eligible then for that discount. So what I'll see is that I will be booking the discount, but you'll notice the discount will be net of that allowance. So 12,500 minus the 600, that is 11,900. And then of course we got a 1% discount. So 1% is $119. Boom, there's that. And then 99% of 11,900 is 11,781. There's that. So you'll notice that the amount I paid is 99% of the bill. The discount is 1% of the bill. And then accounts payable is for 100%. Has to be. You'll also notice, remember, that this credit is to inventory. Has to be to inventory. If it is not to inventory, you have violated the cost principle because you're telling me that this inventory is worth $11,900 when you paid $11,781. Those two things are not the same, right? So don't make that mistake. Very common, right? People will try to give me like purchase discounts or something like that. In this case, the way we're teaching it in this class, right, you will not see that account. Okay? You will not see that account. So very good. You do see stuff like that under the periodic method of journal entries. You will not see it in this class because we are just doing perpetual. Okay, so that wraps up number 9. Number 10, all right, they tell us here, prepare the net sales portion of the company's multi-step income statement. Well, we talked about net sales earlier, so all we're doing here is plugging everything in. We've got our gross sales 265, drops straight in there. We've got our sales discounts, sales returns, and allowances. Boom, boom. Those two things drop straight in, giving us a subtotal here for our contra accounts, giving us a total for net sales. Now you'll notice in this question, they do try to trick you just a little bit by including sales salaries expense. Sales salaries expense is not part of gross profit, is not part of net sales, is not part of anything up there at the top. So we don't care about it. So it goes away. Okay, so it goes away. So what we see then, remember we said net sales was just equal to gross sales minus both of these things, sales discounts and sales returns and allowances. So that's all we're pulling in here. Don't be fooled and pull in that 11,300. It can mess you up. So don't let it. That's number 10. Now number 11. Here in number 11, we are looking and they want us to prepare a multiple step income statement. So it's a little bit involved. You can tell a little bit more going on here than whenever we just had the single step income statement, but don't worry, we'll go through it nice and slow, explaining everything that we are doing. So just like any other income statement, very top line is sales. So we will just simply pull in our sales number. So we look, there it is, 210,000. So I'm just going to kind of draw a line through it to indicate, yeah, we've used that thing. So here's my sales of 210. We will then subtract out my sales discounts and my sales allowances. So boom and boom. All right, those two things have now been dealt with, giving us net sales. Now, if you are looking at like published financial statements, it's very unlikely you're going to actually see this. You will typically just see net sales. That'll be the top line on the income statement. In this, it's a principles class. We're trying to see how this all ties together. So the homework, the exams typically do ask you for this format. But if you start like pulling publicly available financial statements, say for Apple or Google or Amazon or Walmart, then odds are you're going to see that very top line is just net sales on their income statement. Then what you'll find is in a note to the financial statements, right? Because of that full disclosure principle back from chapter 1, they'll actually show you how they came to that number, right? They'll say, all right, we had gross sales of X amount, we had sales returns and allowances and discounts of X amount, and that gives us net sales of this, which you can find reported on line 1 of the income statement, right? And they'll tie it all together for you in the notes. But just to clean it up a little bit, we normally don't see this full computation right here. The next thing that we see is our cost of goods sold. So we pop over, we find cost of goods sold 90,900, just simply drop that in. This is what we said before, right? Net sales minus cost of goods sold. That was going to give us gross profit, and that was going to be at the top of my income statement. Well, there it is. There it is, right at the top of the income statement, right? Now, another thing that you typically won't see in most publicly available financial statements, they don't break out gross profit by itself. Because it's such an easy computation of just the difference between those two things. If you want that, you can certainly get that very easily. You may see it, right? It's not wrong to include it like that, But very frequently it will not be broken out separately. And you would just have net sales, cost of goods sold, and then you would see the rest of this down here. Now, what we're going to look at next, is my selling expenses. So you'll notice expenses is our broad category. Within expenses, we now have two areas. We have selling expenses and general and admin. So selling expenses are what they sound like. They are related to the sales function. General and admin are pretty much everything not related to sales. So we go through here, we see things like sales staff wages, 23.8. We see rent expense, specifically notice on the selling space. So we'll need to deal with that. So that will pop out. We'll deal with TV advertising expense. And you say, well, how do I know that's sales? Well, why do we advertise? To boost sales, right? So that pops in there. And then of course, sales commissions, obviously related to sales. So that comes in there. So here we have that working through. Totaling out, right? So the sum here of those four things is 50,200. Coming on down just a little bit. And let's go ahead and clear everything up again. We will now go and look for our general and admin expenses. So that'll be office supplies, insurance, depreciation, and then of course office salaries. So we'll mark those off. So we had office supplies expense. So office, oh, dadgummit, my markings, I forgot, are going to go away whenever I clear that. Okay, well, that's fine. So depreciation expense on the office copier, that has gone away now. We've got our office supplies expense, that has gone away now. We have gotten our insurance expense and our office salaries expense. So all of those have been dealt with. Yep. Okay, so that's it. So those are the four that we needed. And now we'll simply come down the total, right? So once again, the sum, right? That's what this means. That symbol is the symbol for sum. It's the Greek symbol sigma. And so the sum here is 34,340. Now we've got a total 50,200 plus 34,340. So the sum of those two things is 84,540. That's my total expense, which can then be subtracted from my gross profit to give me a very important title that we have not seen before. This is income from operations. So you'll notice everything up here has to do with our normal operations, our normal day-to-day activity of the company. The stuff down below this point, not the same thing. All right, so we're going to have to deal with it separately. But this, right, if you're making an investment decision, this is what you should be basing it on. Do not base your investment decision, assuming you're only basing it on the income statement, which is another conversation, right? Another thing you probably shouldn't do. But assuming you were, for some reason you had to, then you would want to make the decision based on income from operations, not based on net income, right? Net income, as we'll see, can be easily manipulated. But income from operations is the one that we're most concerned with. Then we come down, we've got this extra section that's new to the multi-step income statement, of course, for other revenues, gains, expenses, and losses. In this case, we had a gain on the sale of a piece of equipment of $61.50 and some additional interest revenue of $620. It's an extra $67.70, which will then be added with my income from operations to give me this total here, $21,630 as my net income. Okay. And so that wraps up this piece here on the multi-step income statement. All right, so breaks out into a few more areas, but we start with sales. We then come down to gross profit. We then break our expenses into two main categories, selling expenses, general and admin expenses. That gives us total expenses. Then the difference between my total expenses and my gross profit is my income from operations. And then of course we add in all those extra things at the bottom to give us total other items. And then of course this plus that gives me my net income of $21,630. So of course the this in that statement was the income from operations. The that I believe was this total other. So income from operations plus total other revenues, gains, expenses, and losses will come down to net income. In this case of $21,630. And the very last thing that we have here is dealing with just some terminology related to and different characteristics of my periodic and perpetual inventory systems. So in this case, the perpetual inventory system gives managers immediate access to detailed, up-to-date information. Of course, every time anything happens with inventory, we're checking it off, right? Boom. Yes, this sold. Yes, this came in. Constantly, right? That's perpetual. records an accounting entry each time inventory is sold. And really, this should say 2 entries, right? Because each time we sell something, we will book both the revenue and the cost. So we'll have 2 entries. That is perpetual. Merchandise inventory balance remains unchanged during the period. That is periodic, right? That is periodic. Has to be. We only make the update at the end of the period. So during the period, no change. Does not require the use of a purchases account. This is the perpetual inventory system. And because we're only doing the journal entries for perpetual, then you don't have to worry about it. If I was making you do the journal entries for periodic, we would see this. I just think it's far too confusing your very first time looking at merchandising operations to look at both. So whenever you move into intermediate accounting, almost certainly you will be required to know both the periodic and perpetual journal entries. So if you are an accounting major, you may wish to go read in on the appendix and see how this works. Come by my office. I'll be happy to look at it with you. But it's not anything that you'll be tested on in this class. Okay, if I ever change my mind on that, I'll be sure to note that in class, right? But as of the time of this recording, that is the case. And then, of course, the last piece here gives managers information to strategically react to sales trends as they occur. Well, of course, the only one that could do that is perpetual, because it is the one that's being updated to indicate the changes in sales and how all of that is occurring. So with that, we have wrapped up our assignment here on Chapter 4. So if you do have any questions, feel free to reach out to me. Let me know. I'd be happy to meet with you in office hours or set up a time to meet with you and go over it. But hopefully this video has helped you. So if you do have any questions, as I said, make sure you reach out to me and let me know. Otherwise, we'll see you next time. Thank y'all so much.